Hello and welcome to yet another episode of London Eye. My guest today on the show is Jonathan Schiessl of Ashburton. He runs an India Equity Opportunities Fund and a Chindia Fund focusing on China and India out of London. Jonathan, thank you very much for your time today first. How do you feel about Asian markets right now? Because some investors feel a little disappointed about how emerging market performance has panned out, and there are some wrinkles about economic performance as well. Would you describe your stance today as bullish or tempered bullish?
I think the issue that to a large extent we face is even within Asia, the divergence in performance is massive. So you can look at China, which has been terrible, India, which has been more recently better, but after a bad last year. And then you can look at the smaller Asian markets like Indonesia, Thailand, which has obviously been fantastic performers. So I think when we look at big Asia, and by that I primarily mean India and China, we're certainly getting more bullish as we stand today. There's a number of reasons for that, but I think the valuations, particularly in the China space, look very attractive. And of course, more recently, a lot of the developments in India from falling commodity prices and a few of the other issues make us a little bit more constructive on India. But yeah, from an economic perspective, it is still a pretty mixed picture across the region.
What do you sense from your end investors? Do they buy this optimism that valuations have come down to a low level, that some of these things which are happening on the margin do help macro? Do you find that story accepted by investors?
Not the ones we speak to, really. It's interesting, we have a mix of investors. Some of our African-based investors are certainly more optimistic. When we go down there and we speak to clients down there, I guess they feel the growth a little bit more. Our UK-based investors are a little bit more cautious, shall we say. And I think if we're seeing those investors are putting a little bit of money back into equities, they're either going into developed market equities or they're going into developed market stocks that have emerging market growth opportunities. So, you know, some of the big staples names. But are they buying emerging markets themselves? We haven't seen a great deal of flow from that perspective yet.
Do you see this continuing to be a headwind, the fact that people turn back and tell you US is doing so well, Japan started doing well, why should I take this incremental risk to go to an emerging market like India?
I think the drivers of what's been happening recently are still in place and are still, you know, if you take it back a level, why have developed markets outperformed emerging markets? I think there's two factors, as you highlighted before. There's an economic factor, which is, you know, some of the inflation concerns in emerging markets. In India, there's the structural issues, the politics, etc. And then, of course, there's the QE that we've got from, you know, central banks all over the developed market, and obviously, as you rightly say, Japan now joining that party. So from that perspective, yeah, you know, that hasn't changed. And I guess the data out last week in developed markets would indicate, whilst things are getting better in the US, but I think we're likely to have QE will last for probably longer than most people are imagining, and therefore the focus probably still will be on developed markets going forward. But when I look at the likes of India and stuff, yeah, I mean, you know, the falling commodity prices and stuff do make us a little bit more optimistic.
So how are you tailoring your portfolio in India right now? I mean, the fact that commodities have fallen, is it just a macro tailwind for you, or have you translated that into your portfolio allocation as well? Because I see names like BPCL, etc., cropping up on your list.
Absolutely. Yeah, we're not huge churners, if you like, so we don't churn our portfolio around too aggressively. That said, I guess the issue is, you know, none of us know if falling commodity prices is sustainable. And so I'm not going to change my portfolio and suddenly start buying consumers of commodities in a huge, you know, the steel companies because iron ore is coming down. Or, you know, obviously the transmission mechanism in India is also slightly complicated. You know, will they carry on pushing up diesel prices? So are there oil marketing companies? You know, there's a political element also that you've got to take into account. Now, you highlight one stock, that's the only stock we own in the whole energy sector. You know, in the past we've viewed as the energy sector as being a sort of hedge, if you like, to the energy issues in India. But we find it quite difficult to invest in a lot of the commodity stocks because, first of all, because of that pricing transmission issue. And secondly, a lot of these stocks are obviously owned as government of India undertakings, and they're not necessarily, in our view, being run in minority interests, minority shareholders' best interest at times.
What's your view on Indian IT? Because that went through a rough patch after the Infosys earnings.
Absolutely.
But you seem very bottom-up in that space. You've got names like Tech Mahindra, HCL Tech, but not necessarily the big companies there. Can you make a big top-down case for Indian IT?
It's difficult. We've very much focused on the bottom-up in the IT sector. We haven't owned Infosys for a long time. It hurt, obviously, in January when the stock re-rated.
You must have felt happy in April, though.
Very happy. Speaking to a number of sell-side analysts, they're saying there's very few funds who weren't owning Infosys at all, so that certainly helped. Indian IT is in a difficult space, I think, at the moment. Sure, they've had the benefit of a falling currency, but I think there's a number of issues, well-flagged issues. There's the issues in the States with the change possible in the regulation, which is potentially a huge headwind, and I'm not sure the market is fully factoring in the implications. I think people are viewing, but probably correctly, that in its current format there will be changes to that regulation. But one way or the other, I think the onshoring issue for Indian IT and the US in particular there'll be a lot more noise about that. I think also Indian IT is very specifically focused on a few niche areas. And they're a relatively small part of the overall, outsourcing chain. It's not a huge market share that they've got. So for us, we're more focused, what's important to us. So what happens to the currency? Is that going to drive my stock selection? No. It really shouldn't be the way, because the rupee has been incredibly volatile.
Yeah.
And to try and predict with any real certainty where the rupee is going to be in 1 month's time, let alone in 1, 3, 5 years' time, it is quite difficult. Of course, we have to attempt it, but the certainty level is pretty low. So really for us, it's more of a bottom-up case, and what we liked about the names we hold, mainly we've got valuation support and a sort of, if you like, more of a turnaround story as well.
What about the domestic consumption story in India? Are you a believer in that? I see ITC in your portfolio, but not HUL, which may have hurt a bit last week when the Unilever offer came.
We've been long-time hold. We've owned ITC for many years. It's been
a good holding, right?
It's been a phenomenal holding. Yeah. When we first bought it, you sort of put your cap on and think, what's the sort of stock which Warren Buffett, if he was coming into India, would buy? And at the time, ITC ticked the box. You had the stable cash flow, the tobacco business, and then all the emerging consumer-facing businesses, et cetera, the agricultural businesses. I'm still quite optimistic on ITC. Yes, it is difficult from a valuation perspective. There's no doubt about it. It makes you swallow hard. But I think if there's any one company out there who, sure, that we'll have periods of underperformance, but we're willing to put up with that because the stable nature of the cash flows, the emerging growth businesses look good to us. Now, of course, I think it's right to be in the staples sector at the moment. I think there's no doubt that the latest data that we're seeing on the consumption on the discretionary side certainly is difficult in India, and I think finally we're seeing some slowdowns across multiple categories, and some of the smaller FMCG companies have been quite stressed recently. And then I guess there's the issue: do you play the rural consumer, the urban consumer? Because obviously the rural consumer has been doing a lot better than the urban consumer. I think as a space, it's a well-known space. The catalysts, the long-term catalysts are still there. It's just the valuations, which in the short term is a bit of an issue. So we have a big overweight stance to the sector generally, in slightly more unusual names, but we're probably comfortable where we are, but it's not been a great generator of alpha for us. Well, ITC's been good, but some of our other names have been a bit poor. But
what else do you own out there? I mean, I can see that you have things like Eicher Motors, etc.
Yeah, that's been a phenomenal performer for us. But we own a couple of other names which are more, it's a Whirlpool of India, for example.
Oh.
That's been a difficult stock for us more recently. We're waiting for that discretionary spend to come back, which hasn't come really. And then Tube Investments, which is obviously the bicycle side, and then we've got multiple other levers to that company. Those two have been a bit, not particularly great performers recently, but we're very comfortable with the long-term picture.
this point, a quick break. We are back with Jonathan Schiessl of Ashburton, who runs a Chindia fund and an India Equity Opportunities Fund, in a minute after the break. Welcome back. You're watching London Eye. I have been in conversation with Jonathan Schiessl of Ashburton, who runs a Chindia fund and also an India Equity Opportunities Fund out of London. How bullish are you on financials in India?
We've been having a big debate in the team about the cyclical outlook of India. So the RBI cutting last week, what do we do with our portfolio? We've got quite a low beta portfolio all in all. And I think we felt most comfortable in the financial space, actually, is where we've been. We've slightly moved around the fringes. We've put a little bit more money back to work in the financial space. The big question is, do you go into the non-bank financials or the banks, and then in the banks is it private sector or PSU? We have a bit of experience. We've only got one PSU bank, we've only got one private sector bank, we've got a number of non-bank financials.
Oh, really?
I think for us, we haven't really come to a conclusion yet. We're probably going to angle maybe for looking at increasing our banking exposure. And then the debate for us is, do you go PSU at those cheap valuations, but obviously there's stress issues there.
Which way are you leaning right now?
Again, HDFC, if you look at HDFC Bank, what a valuation. I just can't stomach that. It's a phenomenal performer. So we're not really looking at that one at the moment. So it's
you have Axis already.
We have Axis Bank. So we either increase our holding or we look to. I don't know. We haven't really, if I'm honest, finished that debate internally because I think it comes back to the macro picture. There's a lot of divergence of views about. Obviously the RBI was a fairly hawkish statement, and therefore, is this just a short rally and will it, roll back over, and are we, jumping the gun a little bit? So we're still having the debate within the team at the moment.
What about the non-banks? Why are you more convinced about those names relative to the banks?
The ones that we play are asset-backed primarily. So we've got the housing finance companies. We've also
LIC?
Nope, we've got HDFC.
Oh, okay, the big one. Okay.
Yeah, we've got the big daddy. Again, the results have been phenomenal. Yes, it's some people swallow it, have a long hard look at the valuation there as well and think it looks incredibly overpriced. But for us, it hits the metrics just on a fantastically regular basis. We've also got a couple of smaller plays in that sector as well. Group Finance, which is part of HDFC, and then we've recently gone back into Schiessl Transport Finance. Again, so all these companies are asset backed. So we haven't really, what we haven't got within the portfolio is sort of consumer finance that's not backed by assets, be it the UCVs or be it by houses. And so that's the debate for us, as well. If we're going to go for another non-bank financial, or do we go to more the consumer side, which is slightly more geared, shall we say?
What about pharmaceuticals? Where do you stand there? I mean, Sun Pharma has been a core holding for you, but have you been adventurous enough outside, like Glenmark and Lupin? Have you? Not
really. We've stuck to Sun. We've been in that stock for a number of years. Another phenomenal performer. We've not tended to. It's obviously quite a small part of the index. I know people were playing pharmaceuticals for a weak rupee play for a while back. Again, we rather focus on the bottom-up story within the individual companies, and Sun at the time, and it still ticks the boxes for us. So we've not delved out too much into other stocks for quite some time. We've been fairly stable in our pharmaceutical area and really just held on to Sun. We've also got Apollo Hospitals, which has been a long-term holding of ours as well, and we're still very happy with that story, although obviously it's a different story than Sun.
Good stocks are not cheap in India right now, whether it's banks or pharma, as you spoke about. The difficult call is to buy something which offers value, but where there's not too much visibility in infrastructure, etc. Of those names, which ones are you debating in your head? Might be a tempting time, but growth may...
We have a very set process. We take a number of large assumptions about India. So first assumption, which many might question at the moment, is that growth is a given. And certainly compared to an economy like the UK, even at trough rates of 4.5–5%, Indian growth seems still huge. So if we assume growth is a given, all right, and we're at the trough now, what we're not really looking for, what we really want to focus on, growth is out there. Any good managements, bad managements can get growth if you've got the right strategy, the right management bandwidth, etc. So what we've decided to do is just focus on the companies where they have very strong, generally, management franchise or a very strong product franchise, so it's defendable. So generally we'd rather go for companies, we don't mind to a large extent paying a reasonably high valuation for a stock if then it offers you that long-term compounding, if they can deliver the growth. I think there's a reason why companies are expensive. You've got to choose, you can choose your time in the cycle about when to buy them and when not to. But generally, we're not afraid to pay up for something which, if over the medium to long term, will deliver the expectations that they clearly state. What we don't want to do, what we find is very difficult, is to buy these stories where you might have very cheap valuations. You're really got to be careful of where you are in the cycle, what management's doing, are they saying are they doing what they're saying they're doing? Are they just talking the talk, or So, for us, we don't generally sort of play too much these sort of restructuring plays, if you like, and these cheaper, extremely cyclical plays.
Do you speak from experience? Have you made one or two mistakes in the past?
I think everybody's made mistakes.
No, specific to the Indian market.
Yeah, I could say, we looked. If I think about the portfolio this year, we did quite a lot of work on NMDC when they did the issue.
Did you buy it?
We did take it.
You're in good company. A lot of people did. And
it was looking extremely cheap. But again, then you start thinking, right, what's going to happen to iron ore pricing? There's a nice dividend yield on there. It's a quality company. This wasn't a particularly painful experience. I'm just thinking one more recently. And it just, the trouble is there's too many moving parts. And when you're relying on government, if you like, and what's going on with it, you've got the external issues with iron ore, what's going on globally, then you've got the Indian issues as well, which to keep a track on is very difficult for us. So we'd rather sort of more focused on the more niche-y, well not niche-y, but the more focused type stocks in India.
Generally, are you leery of government-owned companies?
Look, I'm not saying all government-owned companies are bad. We do have a couple of them in the portfolio, but generally speaking, we would rather have, the trouble is, as you well know, from time to time, government entities will do national service, if you like. And, we have to be aware of what we are. We're a minority investor. And it can, and sure enough, the market then, generally speaking, these shares are generally a lot cheaper than the better private sector companies. But generally speaking, we only have we'll only ever have a couple of government of India undertakings within the portfolio.
What's your bigger worry about India this year? Is it that India will underperform in a relative sense because of growth issues or macro issues, or do you see an absolute level of risk to emerging market equities where markets generally fall and India is one of those falling markets?
I guess from the big picture story, India's the geared play in many respects. It's the geared play on risk on, if you still believe risk on is happening, or risk off. And it's obviously the geared play in falling commodity prices and all those issues. That has not changed. India, on a relative sense, even to other Asian markets, is now, on a relative sense, trading at a slight premium. And I think India deserves a premium for the growth and the quality of the companies you can find there. But if I look at China, say, where China's probably trading at 1 to 1.5 standard deviations below its valuation on the relative basis and valuation compared to elsewhere. But then you've got all these other issues which people are worrying about China. And then it comes back to it comes back to really what the crux of the issue. Emerging markets, they've been underperforming hugely developed markets, and as we said, there's those two factors. They haven't changed. I believe most of the money that's being generated by QE is probably going into US. From a macro perspective, the US is looking pretty good. And so I think I can't see, as it stands today, generally speaking, EMs as an asset class outperforming DMs yet. Still not there. But within that EM universe, there's been such a variety of performance. I think big Asia, so India and China, probably can start outperforming the smaller Asia, which has done so well for the last couple of years. I think there is scope there. I think the issues for India, more particularly, the positive side, you've got, as we've talked about, the commodities, but the issue is the politics. And the politics has not gotten any easier.
Yeah.
Obviously, you've got the election coming up, so is the reform process stalling? Let's be realistic. They're not going to push through contentious. They can't push through contentious reforms through Parliament as it stands today. So there could be some disappointment from an FII flow perspective into the equity market. On the other side, the good news, I think, is what's been in the bond market. Some of the recent initiatives in the Indian bond market are very positive. So that should help flow somewhat as well to mitigate perhaps some disappointments if they come through on the equity side from politics.
Jonathan, a pleasure. Thank you very much for your time today.
Thank you.